Welcome again to Bullish Banter, where we discuss investments, financial policies, and a raft of other issues which definitely affect not only your personal finance, but your investment decisions. I'll be your host today, Jesse, and the guest I have needs no introduction.
Hi guys, Rufus Kamau here, markets analyst at FX Pesa.
I hope you learned something at least on the previous episode, specifically regarding fundamentals and trading. And we'll just go on a little bit on a tangent, whereby the price of fuel in Kenya was increased by 2 shillings, I believe, right?
Yeah.
That is the petrol. As an analyst, any projection, maybe it will continue going up or...
I think we'll continue seeing much higher prices.
Okay.
Unless something changes fundamentally in the global macro.
Okay.
So the current demonstrations we are seeing in Kenya, South Africa, they all boil down to one thing.
Okay.
High cost of living.
Okay.
And the only reason people would say there's a high cost of living is because the retail prices are going up.
Okay.
So when you go to buy unga,
Yes.
you go to fuel your car, all those prices are moving higher.
Okay.
So today we'll be talking about inflation, try to understand what it is, how it affects you, and perhaps how you can run around it.
Okay. It's very good. I think that covers the definition of inflation in summary, right?
Yes.
And we started with the price of petrol, diesel and the rest.
Yeah.
They do play a major role in a lot of factors within an economy, specifically regarding the cost of price.
Yeah.
And as a trader, what are some of the indicators so that you know, okay, things are not going well?
I don't know if you keep receipts. Personally, I do. So if you look at the monthly budget
Yes.
that you do every month, if you got a receipt for, let's say, March last year,
Yes.
and then you compare with how much you're spending on March this year for the same number of items,
Yes.
you know, like food, soap and all that shit, tissue paper and all that, you would realize that the prices have significantly gone up.
Now, this is if you're shopping in either Carrefour. Is it Carrefour or Carrefour?
It's French.
Okay.
Can't pronounce
We go
that.
to the next one. Ile ya nyumbani.
Yeah.
Naivas, you go to whichever supermarket, right?
Yeah.
You'll definitely have a receipt.
Yeah.
Now, there is this other person who does not shop at a supermarket.
Yes.
And the local retailer doesn't have receipt.
Yes.
How do you track of your expenses for that person? Because I know sometimes when unaamka, you say, I need just a quarter of sugar because I need a quick breakfast and then I'm gone.
Yeah. So sometimes when you're measuring inflation, you might also consider your level of income.
Okay.
So you want to see, let's say you haven't changed houses and you're renting.
Yes.
So you look at how much you're spending on rent as a percentage of your income and how much you're spending today.
Okay.
So you compare last year with this year and you see how that has changed.
Do you normally say, do you like have a recommended percentage of your residential? Because that is some in a way, a permanent expense.
Yeah.
Because you have to pay it either way.
Yeah.
Do you have like a percentage of your income you need to decide?
No. I've seen a lot of guys saying, oh, it should be this percentage, it should be that percentage. No, enjoy your money. Tumia pesa ikuzoe.
Okay, nice. So inflation definitely plays a role in how people decide what to invest, which schools to go, and of course, trading, what to buy, what to sell, and stuff like that. In terms of personal finance, we have already covered rent and shopping, right?
Yeah.
The most important aspect. You cannot, I think they usually say, you can either out-earn your expense or underspend your income.
Yes.
And this is from Kahome.
Yes.
Credits to his article, especially on personal finance. How do you out-earn your income? At least based on your involvement in financial markets? So
out-earning your expenses is literally making sure that your income is expending at a much higher rate than the amount you're spending, let's say per month, per quarter, or whatever that period is. So it involves sitting down, reviewing your expenses, and also your income. So if, let's say, you're employed somewhere, you could consider, let's say, taking on a side job. Then you'd have more income coming from your side hustle. You could also, let's say, take on an extra course, academic certification that has a direct impact on your level of income, especially if you're in government and you get some extra accreditation, then you probably get a higher salary.
Okay.
So you could also look at career growth. Let's say you switch your job from one company to another that pays you better.
Yes.
Switch your role from this particular profession to the other profession where you earn more.
Yes.
So there's numerous number of ways, including creating content online that you can expand your income.
Okay.
And make sure that you are out earning your expenses.
Interesting. Now the other side. Under spending, at least compared to your...
Not a big fan.
Okay.
So
why say so?
It's a very common thing that you'll find, especially from personal finance executives. They'll probably tell you need to start budgeting your expenditure. You track down every shilling, how you spend it.
Yes.
But you see, money has a very... personal touch.
Yes.
And different people have different preferences.
Accurately put, emotional touch.
Yes, emotional touch. And it's also very sentimental.
Yeah.
So there's a person who would be free to, let's say, move to a house that he or she pays a lower amount, and there are person who will not cut that.
Okay.
So there's a person who would switch from a guzzler and go to a more economic car.
Yes.
And then there's a person who would take nothing less.
Okay.
So you can't just advise people to cut the expenses because you don't know what they would be comfortable to cut.
Definitely. I think if you go on a Kenyan road right now, you will see cars going in the excesses of at least 100k USD or even more.
Yeah.
Or even up to 500k USD. That's around maybe 60 million.
Yes.
Is that a good measure of inflation is not eating on everybody, but just a few? Because I personally believe inflation will always be there. There is no time prices of goods will never just come down consecutively for a whole year.
Yes.
Right?
So inflation basically affects the people who have the lowest income most.
Yes.
So
Unfortunately.
let me give you an example. Let's say the cost of unga.
Yes.
The cost of unga, let's say it has gone up by about 100% in the last 2 years.
Yes.
So
right
3 years.
Around 211 per 2 kg packet.
Yes.
Depending on where you get it, 211 to 250.
So if you're a high income individual, let's say you are earning somewhere between $1,000 and $2,000 in a month. If the price of unga moves from let's say 120 to 240,
yes,
you'll still be able to afford that. So it will take some smaller proportion of your income.
Yes.
But then for the guy who is earning, let's say $100, $200, $300 per month,
yes,
this guy will be affected because the spike in unga prices will take a larger proportion of their income, and they'll have less savings.
Yes.
So inflation hits the guys at the lowest level of the economy, the worst. And that's why if you see demonstrations, it's mostly the people on the lower income levels that are first to be demonstrating about high cost of living.
Okay.
Yeah.
Nice that you mentioned at least in terms of income and the hierarchy in terms of income levels.
Yes.
Now, there is the other part which I think inflation is quite significant, and in the global scene,
yes,
every person looks at CPI, which is the Consumer Price Index, which it depicts the level at which the price is increasing in the US, right?
Yes.
And I believe it has a direct correlation with the dollar.
Yes.
Right?
Yeah.
Maybe you can elaborate on that and how to apply it at least.
So every single country in the world has a central bank.
Yeah.
Of course, some of them don't. There's also some other economies that share a central bank, like the Eurozone.
Okay.
So the central bank always has a mandate to ensure there is stable prices in that economy.
Yes.
So if an economy doesn't have stable prices,
yes,
then you tend to find investors running away, and it becomes very chaotic. So to ensure there is stable prices,
yes,
the central bank tracks the CPI.
Okay.
So the CPI is literally a basket of commodities that are consumed by the average household within an economy.
Okay.
So in Kenya, we normally see these on TV. We'll see the basket of food. It will normally have a packet of unga, packet of milk, tomatoes, hotels, bar soap.
To the mountain.
Yeah.
A good sack of potato,
Yeah.
which unfortunately I saw somewhere. I'm not sure this is true. It is going for 250, which is quite unfortunate.
Yeah, I saw that on the news.
Yeah.
So when you track that basket
Yes.
over different periods, let's say you look at the price of that basket on January compared to February and then March. If that basket is getting pricier, then the prices are not stable in the economy.
Okay.
So in larger economies,
Yeah.
they have a much wider basket where they consider the most sensitive things that affect a household.
Okay.
One is rent. They also look at healthcare.
Yes.
They also look at transportation, among other things. So if prices are changing rapidly, it's bad for the economy.
Okay.
So in order to stabilize prices, central banks will normally use a very common tool called interest rates. So they will alter interest rates to make sure prices are stable.
Okay.
So when inflation is on the rise, they will raise interest rates such that economic production slows down a little bit, and then prices stabilize.
Okay.
So if it's the opposite, the goods on that basket are becoming cheaper, means that the money has a stronger value. In that case, they cut interest rates, ensure there is more money chasing after those goods, and then the prices stabilize.
Okay. Nice. I saw recently there is this, it is a panel discussion, more or less like a testimony, where the chair of the Federal Reserve, every quarter, I believe, he goes to the Congress to give the overview of the economy.
Yes.
And one of the most heated debate was between Jerome Powell, the Fed chair, and Senator Warren, right?
Yes.
Where she was saying, if you increase the interest rate at the rate or at the pace at which you're doing, it will cause at least 2 million plus jobs to employment, right? So in terms of inflation, when it is rising, it is bad for your expenditure. But there is the other side effect. If they try to reduce it, it will cause unemployment. And there has been this talk. In other economies is around 2% target for inflation on annual basis. In other economies, 5 is good. Is it probably time they adjust the inflation in a way that it doesn't also hurt the income sources of those who will be unemployed?
I think this takes us to Keynesian economics. So we won't be doing this here. But the idea is, if you hike interest rates aggressively, what you're literally doing, you are making the cost of loans very expensive. So you are incentivizing more people to take less loans from the commercial banks. So when there is less money in the economy, then you start seeing prices stabilize. Prices stop going up. But then the impact is that companies will have very expensive credit from the commercial banks. So in order to cut their costs, they cut jobs. So a lot more people become jobless.
Unfortunately.
So that's the bad thing about the current approach. There are other models that have been suggested. We saw QE, quantitative easing. We saw a proposal about incentivizing people to save. So for instance, what you're seeing here in Kenya, during COVID, there was a lot of money excess within the economy, resulting from quantitative easing programs, such as the zero transactions from bank to M-Pesa and M-Pesa to M-Pesa during COVID. So in order to pull that money out of the system, if you raise interest rates, then you kill more jobs. So instead of doing that, you incentivize people to save this money so that it's out of circulation. Then in that case, prices tend to stabilize.
Interesting. There is a different angle I'd like to take. This is probably controversial, but it actually poses an interesting thesis. If during COVID period, we had zero transaction charges between banks and, of course, your mobile money, where you would spend on whatever you want to purchase, right? Now, with the reintroduction of the transactional charges, including maybe M-Pesa, which was quite high, does it have a direct correlation to why inflation in Kenya is actually high? Because we not only can access money from our bank at high transaction, but you can get an extra credit from other credit apps and and facilities. So is it because we have so much money that prices are going up, maybe, besides of course the government?
So there's a large number of factors that contributed to the inflation. The biggest culprit being oil prices. Oil have like a direct impact on every other product that you're consuming here.
Okay.
So if oil prices are up, then generally other prices will be up.
Okay.
So electricity prices have been going up. That also is having an effect.
Okay.
But then when you consider what happened during COVID, when we had excess money
Yes.
in our pockets, then we would buy more stuff. So that in that particular scenario where you have a lot of money in the system, chasing after fewer goods
Yes.
is what results to higher prices.
Okay.
So you remember when, let's say, there's a shortage of petrol,
Yeah.
you go to the nearest petrol station, they don't have petrol.
Yes.
So when you go to the next and you find they have petrol, then there's a large number of people queuing for that petrol.
And they would hike the price.
They hike the price.
Yeah.
So it's the natural outcome across the economy.
Okay.
But now, reintroducing the rates
Yes.
for M-Pesa to M-Pesa transactions, bank to M-Pesa transactions, then that has the effect of pulling more liquidity, because every time you transact, some money is pulled out of the system.
Okay.
So in that case, it helps to tighten and stabilize prices.
Okay.
Yeah.
Nice. Now countering it, because at the end of the day, prices will keep on going up.
Yeah.
And some factors are exogenous. You cannot really work around it or work through it.
Yes.
So when you are trying to, for a trader per se, inflation definitely comes in. You see something happens to the price of gold. You see something happens to the price of Euro USD.
Yeah.
And the inflation or CPI print doesn't just come out one. Inflation has been rising by 6%. It comes with a raft of other data included in there, including even what we get from Kenya National Bureau of Statistics in Kenya here.
Yes.
How do you take that information and put it in an action plan? Therefore, maybe you will say, I will buy or sell whatever asset class.
Yeah. So first, I would like to state that despite Kenyans having to work full-time just to earn an income, it has become a secondary job to make sure that the money you made doesn't lose value to inflation.
Okay.
You know, like if you save 100K in a bank and you keep it there for 5 years, if the average inflation rate is around 5-6%, that money will only purchase half of its value. Because of inflation.
Okay.
So it's a full-time job to make sure the money you earn is earning even more money in order to keep pace with inflation or even out-earn inflation.
Okay.
So if you're a trader and you're trying to understand inflation data, now that we understand how it influences the prices, then traders tend to follow the central bank's lead. So if the central bank is looking to tighten and hike interest rates, then you know that has the full effect of strengthening the currency.
Okay.
So in that case, if you analyze this data that the central bank is looking at and see that it's going to do a hike, then it's in order to buy that currency.
Okay.
So investors are currently trying to, I would say, praise their threats before the central bank makes a decision.
Okay.
So if it's the opposite, if the central bank is cutting interest rates, then in that case, it should be weakening the currency.
Okay.
So you should be shorting before that.
Okay.
Yeah.
I think that is a good way to go about it. Now, that is for trading. In terms of, I think we were speaking besides in terms of stocks. How does one factor in whatever inflation number is coming out and therefore deciding, okay, this stock is performing well, or how it might affect even generally the stocks market? Because there is a correlation whereby if inflation is high, stock market tends to decline in price.
Yes.
Maybe you can elaborate on that.
There's quite a number of factors when you talk about inflation.
Yes.
Or quite a number of sources.
Yes.
So sometimes there's what we call supply side inflation.
Okay.
We saw inflation rising during COVID as a result of supply side. So when Russian oil was cut out of the markets, then oil prices really went high. And it was affecting companies, especially the ones that literally depend on oil to do their production. Their prices would definitely go higher.
Yes.
There's also the demand side. So if you're in an economy where a majority of your clients are experiencing a higher inflation, then a majority of their income will be going to basics. They'll be buying food, paying rent, transport, and maybe they won't have enough money left to buy an iPhone or a Tesla or something of that sort.
Yes, especially luxury goods, basically.
No, luxury goods are not affected.
Okay.
The guys with the big money will still buy bigger stuff when there's high inflation. It's a funny scenario. So if there's high inflation and let's say the price of a Ferrari goes up, the clientele that buys Ferraris will still buy.
Because you still get the class that it comes with. So
Yes.
yeah. Okay.
So if the price of a luxury good goes higher, then it's viewed as an even better product because it's exclusive.
Okay.
Yeah, only a few people can afford it.
Maybe it's not all stocks, right?
So that's luxury goods per se. But then if it's discretionary products, let's say you are planning on buying some new electronics, replenishing your house or office with new furniture. If inflation is high, you'll probably just bench that first.
Yeah.
And then consider another period.
Okay.
So demand can really go down for discretionary products when there is high inflation.
Okay.
Then there is the monetary base inflation. This is when the monetary base expands and there is just excess amount of money in the economy without changes in demand or supply. So in that case, we find that people naturally just buy more stuff. So personally, if your income increases today, or let's just say something like Fuliza.
Yes.
So if your Fuliza limit expands from let's say 10K to 300K today, you would probably buy more stuff, right?
Plodi maguta.
So the thing is, when the monetary base expands and people have more money, then they buy more stuff. So you have to identify the source of the inflation in order to understand how it affects the company.
Yeah. I think that boils to the first point we were saying, whereby inflation or even spending money is more of an emotional thing than actually a logical decision people make.
Yes.
And I like to say this quote by this book, Psychology of Money, whereby most financial decisions, at least within a household, are made at the dinner table. You say, hey, my son, today you are going to go to this school. We have decided we want to get you good education. Tomorrow we are going to barter. We're getting you a new shoe, especially when the income rises. So it is not like the previous shoes were not working. It is just because you feel, okay, I need to look better and I believe this would add value. And maybe going forward, there are certain things which maybe not somebody within the financial market would be familiar with. Like there are some people who will not be bothered by Kenya National Bureau of Statistics website to see where the inflation is. What are those key identifiers that any person who is not necessarily within the financial market would want to know to identify, okay, things are not going well, besides, of course, the fuel and maybe... because I think we have stuck so much in Kenya, especially within the unga, which has been stagnating for, let's say, 6 months now. What are the identifiers you can use to know things are going bad?
I think tracking how people spend their discretionary income is a key thing.
Okay.
If you go to your local joint and look at how people are spending, you can tell how the economy is doing.
Interesting. Do you normally look at, now last time, people were spending maybe a whole bottle of 750 or they were buying maybe instead of...
just a beer. And a bottle of water.
Interesting. But if you go to a Pizza Hut, people instead of getting one whole pizza, they'll go for Tuesday double. Right?
You can also track the population or the population traffic in malls. So when things are good, people will be like jump packed.
Would this be when income comes around, maybe the end of the month, start of the month, or just...
Yes.
Okay.
So if you look at, let's say...
Because that is when actually they have money, so they are making decisions right there and then. Interesting.
So if you look at the traffic, let's say in a mall, on the end month week, and then you compare that across different months, then you can see when there is more money in the economy and when there is less.
Okay. There is this term, just to piggyback on investing, it's known as defensive investing, whereby you'll find products within the health sector or companies or stocks within the health sector tend to perform better whenever there is high inflation as well. I think it is health sector, defense, and stuff like that. Is that thesis maybe something true?
It works perfectly. It works perfectly.
So you can focus at least your investment in maybe a hospital or a company like Pfizer. Of course, this is not an investment advice, but they do tend to perform better when prices are good. What is the reason behind that?
So the logic is simple. If you have a flu today, you'll just go to your nearest medical facility and buy medicine, whether you have money, whether your income is high or not.
Okay.
For spending in medical, it doesn't correlate with how much you are earning. So whenever you are sick, you buy medication. That's it.
Okay.
So it's something that people spend because they need to, not because they want to.
Okay.
So the same case applies to consumer staples. So if your kids take bread in the morning, you're not going to stop buying them bread because there is high inflation. They will keep getting that bread despite the financial
to take,
situation.
maybe cassava or something.
No,
You never know.
when prices are rising for bread, the demand in cassava will probably be rising too.
Maybe it's because Jaden says, no, I can't check anything other than Broadways.
Yeah. So there are those basics that you must spend.
Okay.
We call them consumer staples.
Yes.
Products that you consume because you need, not because you want.
Okay.
An example would be unga, cooking oil, bar soap, and all that stuff.
Nice one. Do you keep receipts of your chemists, whatever you buy at the chemist, in terms of price of those medicine?
No.
I thought so too.
Yeah.
For some weird reason, people don't tend to know the price of Panadol, which was last year to today. For some weird reason, I don't know why, but maybe our listeners can tell us if they know the price of whatever Panadol or antibiotic you bought last year, and if there has been some price increment up to that.
Let me tell you one thing. If you need Panadol, you have a headache right now, the price was 5 bob, let's say last month.
Yeah.
You go to the nearest facility and they are selling at 10 bob.
Yeah.
You don't care about the price. You care about the headache more.
The end result.
Yeah.
Nice one. I think that will be it for today in terms of inflation crash course. And I'd like to invite our listeners, should you have an addition or a question to follow up on this, kindly do share it and tag us on your question, and we'll be glad to cover it on the next episode.